But that aside, Ajay, what is it that you're making of the broader end of the market? While it's been victory small and mid caps for the last 1 month, would you say time to tread with caution right now? Or would you say tactically this call of a larger exposure to mid and small caps will continue to work well?
I think, two things. One, I'll promise you one thing we are doing is not rejoicing, because what we see, the misery all around us, our employees, their families, our friends, is not something we rejoice. And I think it's something which has to be, said, that all of us in the market, economic, we're doing well. And I think you want to use your forum to say, listen, guys, open up your heart, give out more than one. You don't need to buy hundreds of crores of real estate houses this time. It's better to put it to work for people who need it. It's kind of really, really sad to see that our big celebrities, real estate owners want to spend hundreds of crores on houses when India's misery is so deep. So I think there is a need to be aware of what we are socially. So I would not use the word rejoicing. I would use the word a little better to say, I think it's been comforting to most people to see their portfolios in the green, so that at least one big worry of investment is at least less in the current context. So that's less. So that's the good part of it. And number two is, you said tread with caution. Obviously, this market is expensive. Every single stock, you can pick up any stock and you can argue that it's a 3-year time frame, it looks good. Immediately, the April, May, June numbers are going to be, bad to worrisome to mediocre. I don't know which one would fall each of the companies, but by and large, we know for sure that July, August is not going to give you the good news. So you're really buying today for a planning at the end of the day, leave aside commodities, but all other companies, you are buying only on the one context that you're buying for longer term period, you're buying for the festive season, and you're hoping against the third wave. And, you know better than anybody that exuberance is part of the system, pessimism is part of the system. So we may be perhaps on the exuberant side at this time.
Ajay, last week one began to rethink what happens to metals, whether this is a structural trade or just a near-term one with the best behind us. How would you approach metals now?
Oh, the best is far ahead of us. Let me be honest to you. The best is far, far ahead of us, and and it's a typical market rotational play. Investment in steel, etc., commodities give phenomenal return in the last 3 months. At which time the Bank Nifty was sulking. If you remember it, Bank Nifty today is just exactly the level of March 31st. Same rotation play will happen with the steel. We know the demand is going to be lower in May and June as companies start to close down, particularly the auto sector and the durable sector, etc. So demand will be lower, definitely. But come the September time, you will find that this sector will again come back into favor. And the good part of the sector is it's the cheapest sector of the market. Sure, you can talk of historical P's, historical trends, but what people, most analysts miss out, that the first time these companies are coming from a very, very wonderfully balanced balance sheet platform. It wasn't true for the last 10 years. They were expanding, they were borrowing, they were expanding, and borrowing at very high rates. For the first time, deleveraged balance sheets, foreign currency loans re-rated down to 72.5 to $1, which is unprecedented. That means they appreciated over the years, so you'll find that their balance sheets are a lot better. They're paying back much less money. And the fact is no supply is going to hit the market in the next 12 to 16 months, globally or domestic. It's a wonderful story. The market is giving you a chance to go in again. If you're not there, if you're there at higher prices, you may want to average out, but certainly not it's the past is behind it. The best is still to come.
Ajay, personally, my view is that it's time to stay long on commodities. But then, if I look at the house view of one of the most respected strategist, Neelkant Mishra, he's come out with a very logical argument, which is that the Chinese regulatory authority, they are very vocal about the fact that the commodity speculation has gone too far. Also, based on the historical parameters, some of the metal stocks right now are trading at historical highs. How would you defend the China factor and the valuation factor for a metal investor or a metal stock investor?
Okay. Let me take the valuation factor first, and that's much simpler to argue. The last decade of the commodity plays and for the steel industry was a play on expansion by leverage. So whether General Steel, General Steel and Power, or General, anybody, SAIL, they were expanding furiously, and that's the last 10-year story. They look at the capacity expansion of each of those companies was 4 to 5 times. And they borrowed money, they didn't raise equity, and therefore they were in a leverage trap. Look at the balance sheet 4 years back and look at the balance sheet today. Phenomenally different. That's one big thing. So the context of valuation changes dramatically if your debt to equity is 4 or 5:1 on a loss-making company to a debt equity of 1:1 on a profit-making company. So what I think the most analysts miss out is that the balance sheet has changed so dramatically now that the context of those valuations has lost totally. You got to look at new paradigm saying these are going to be companies with almost zero debt in 2 years' time and with a decent expansion plan and learning lesson, they will raise equity, do what it needs to be done. So the context is very different, and therefore the valuation norm to say link it to the past, is like saying that, the child could not run 100 meters when he was 8 years old, but now he's 18 years old or 21 years old. So now he's running it sub 10, but that's not going to continue. No, it's going to continue. Of course, it's going to continue. The number two is China. I think one other factor which most analysts ignore is the fact that this government particularly has been very strong, vocal, and active in giving tariff protections. Where did the steel turnaround story start? It started with a tariff protection year and a half back. And that's what the trigger was. It was not demand. Global prices came later. But at the worst global prices, this government went in and did a major tariff protection. So China will do what it needs to do. On commodity side, they can at best play with paper profits, futures, options, commodity futures. You can play with that. But the real ground story is that if there is no new supply coming in, and economy may grow by 4, 5, 6, whatever the percent is, and we'll come to that, this money will be made by Indian domestic companies. You can't ignore it. Number two is there are only 3, 4. It's a re-rating like cement. You remember cement 7 to 8 years back, Nikunj, was disaster. There were 20 companies, each competing to sell in the market. All were over leveraged. And look at cement today. 5 companies, beautiful balance sheet, making tons of profit. Steel has gone through the same thing and has come to the same thing. Commodities, it's quite strange that the company with the worst governance mechanism today holds all the tricks for commodity in India. But, there is no substitute for that company, whether we like it, don't like it. And that company has given returns to shareholders. Every time he's done a buyback, people sold. They must be looking really darn stupid to have sold in the buyback.
There is a very interesting pocket which is now getting created. It will start with perhaps a Paytm IPO, $3 billion. Then you got Zomato, followed by Delivery and maybe Nykaa. So 2021 belongs to the so-called startup space where everybody said, oh, I wish I can buy Paytm. Oh, I wish I could buy Delivery. Oh, I wish I could buy Zomato. These companies are going public now. What does that mean for an investor like yours? One side we are talking metal stocks, but the real dhamal, if I may use the word, and excitement will actually happen in some of the so-called new age IPOs.
Of course they will happen, but also look at the valuations. It is absolutely silly season for these valuations, and the test will come when these are listed and they start to report performances. Delivery, that basic thesis of that business is a low-end 6-7% EBITDA thesis. If that can get valuations of 100, 200 times P, that tells you the state of the market is that liquidity is at its peak. It's nothing to do with the fundamental of this company. None of the 3 companies deserve anything close to this valuation. But who are we to argue from the market? If Fed is going to give so much of money to these companies, and you see the amount of money coming to fintech, even today new fintechs get money. Can you believe it? We must have 200 fintechs in this country at this point of time. Economy growing 5 to 6%. 200 fintechs are going to come and try to take your space of whatever you're lending, etc., etc. They're going to do. But the valuation is stratospheric. So I would say it's good. The market is deepening. We are getting e-commerce stories. But if you look at even the US, the retail e-commerce story has got only pockets of exuberance there. The real exuberance came in technology companies in the US who were serving e-commerce digital. The consumer companies went only so far at this point of time, and very few cases to see, let's take a Paytm equivalent to get the valuations. It's not a PayPal or it's not this thing at the end of the day. Let's be honest about it. So market liquidity can do funny things to funny people and funny companies. And our institutions, the big investors in these companies, have a long history of notching up losses. there is no worry about it. You can go 20 years, they've done it just now. Archegos, that we all know about, exploded. And look at the underlying scripts that were there. Similar stories were there. So for investors like us, I think there is a need to be there, but need to be there with caution to see we buy at the right time. You saw just now India Mart. It did a QIP 8600, the share price is 7200. Surely it may be too early, maybe 5 months down the line, but you don't expect the guy to go so wrong in a matter of a month that the price travels from 8600 to 7200. Many such stories will happen. So exuberance, yes. Good, yes. Deepening of the market, yes. Buying carefully is equally essential because the big money has been taken away by the PE funds who are listing and asking your valuation at this price. You will get the short end of the stick, my friend. The big end, the money has been taken away by the PE funds.
Okay. Ajay, we all ask all our experts their advice or strategies on how to get rich. So I want to get your key takeaways today for our viewers.
Okay, I don't know, rich or, rich is becoming also an extended thing because many people's idea of rich, as we said, is that if I want 20 houses, then I feel rich about it. So I'm not sure which category one wants to fall. But I think this is the time for most investors to look at protecting their capital more than getting aggressive on the alpha. And that means reorienting their portfolios to the ones they're sure about in the longer term. And it could be very familiar, the old culprits, then so be it. Let boring theme be invested in, so be it. But one can reasonably assure the fact that something like a divestment story like a BPCL could be a sure bet in terms of if it goes through. I'm not promising it will go through, but if it goes through, it should give a very handsome return to most investors. I would say re-rating fertilizer companies would give possibly a big alpha return in the system. The regular culprits, the Hevel, the Eicher of the world, Asian Paints, I think they'll give reasonable return over the period of 1 year. They may give you a shock by June, end or July when the results come in. So there is no hurry. You will get these stocks, make a list, buy peacefully, and that's the way to get rich. Buying at peaks is never going to make you rich at the end of the day. We have all learned the hard way.
All right, Ajay, thanks so much for joining us this morning. Good chatting with you as always.